So this is kind of fascinating how this works to me with options, is that these two trades are bullish, but one has a obligation and one has a right. One has a higher probability and one has unlimited potential. Let's discuss the basics of options, what we call pillar 3, and that's the basics of option strategies through the lens of the collar strategy. Now, when you are dealing with options, you probably want to understand shares first, because that's kind of the basics of options, because options are a derivative of shares. You have to understand the shares, and that's pretty simple for most of us to be able to understand, if not all of us to be able to understand what shares are and what are the risks associated with shares. So if you buy 100 shares, we all agree that we're bullish and we want it to go up. When you buy shares, each share that you own equals the delta. So if you have 100 shares, that's going to equal 100 deltas. If you bullish when you buy the shares, which you are, your risk is to the downside. When you're doing a collar strategy, you are selling a call that is bearish. When you buy a put when you're doing a collar strategy, that is also bearish. And so the way I like to break it down is that if you had 100 shares, which we all understand if we bought, then you would have positive 100 deltas. If you sell a call, which is bearish, that's going to give you negative deltas. So let's just say it gave you negative 25 deltas. If you buy a put, which is bearish, that's also going to give you negative deltas. And I just say for easy math, it's giving us 25 negative deltas as well. So if we were going to put on a collar strategy that looked like this, of buying 100 shares, selling a call at the 25 delta, buying a put at the 25 delta, that would equal overall positive 50 deltas. So it's basically having 50 shares. You can think of it like that. You're starting off with 50 shares. The shares up here that you purchase is static. It's going to stay the same. It's always going to be 100. But the option delta, that is dynamic. That's going to change. It's not going to always be 25. It's going to change 100% of the time. It's going to change. It's not going to stay at 25. It's dynamic. This delta, this overall delta, then it can go to having all the way up to having 100 or 1, trading just like stock, or it can go to basically 0. And the way it can go to 0 is that for example, your put or your call can equal 100, or the put and call combined can equal 100, and that's basically shares. That's how you have a limit to the upside when you are selling a collar. When you sell that call, you have a limit to how much you can make to the upside, and that's why you have a limit to how much you can lose to the downside with that put that you buy, because it's going to eventually become 100 and it will offset the shares completely. So let's break that down a little bit more so we can go over the basics of options here. Just want to take a quick second and say, if you're interested in learning more, please consider joining our trading club. You can do so for a 90-day trial period for a flat $60. Check out the description below. Now back to the video. If we were starting off and we were selling this put here, as I say, for a cash secured put, this is a basic strategy, and it would give us the obligation to purchase at the 62 strike. We would collect some monies, let's just say $102, $103. That $102, $103 would lower our cost basis, and this would be our cost basis. It's max loss here at 60.98. And we would be bullish if we were doing this trade. Right? If you sell a put, you're bullish, and you're going to get, in this example, about 20 deltas, 20 dynamic deltas. That can go higher, that can go lower. If you're the option seller of this put, you want it to go lower. But let's just say it went higher and it went to 100, and you had to take ownership of the shares. Once you take ownership of the shares, if you're doing the safeguard type of strategy that we teach here at Dorian Trader, you could do what is called a covered call, and you can sell an option, a call, against your shares. And if you did that, it'd go to something like this. And if you did this, you would see that you're collecting about $200 of premiums to sell that call if we pick this 72. And when you sell a call, it gives you the obligation to sell shares at the strike price. So you already have 100 shares, and you're giving someone the right to buy your shares at 72. So this is where you stop winning at when you sell this call. But for the basic of options, when you sell a call that's bearish and you want it to go down. But if you already have the shares, then you covered, meaning that because you have the obligation to sell shares at the 72, you don't have to go buy shares or go find shares. You already have the shares. So you're covered if you need to sell the shares to someone at 72. So what that means is that if you already have the shares, you have the ability to make all the way up to the 72, and then that's where it stops. Because basically that delta is going to eventually become, that 72 strike delta is going to eventually become 100. And so that's where you stop winning to the upside on this covered call. So as you can see here, it's saying your max profit is 570. You can't win if it went past the 72. So for example, if it went to 80, you're not going to win another $8. No, you're going to stop winning at the 72 for this covered call. So it's a basic type of understanding the basic option strategies. Selling a put is bullish and you have an obligation to purchase. If you have to purchase, then you now have 100 shares. If you sell a call against it, selling a call is bearish. It's a basic strategy and you have an obligation to sell your shares. Now, when we turn this into a collar, and as I say, we decided we're going to buy the put here at the 62 strike, or if you buy this put, this is bearish when you buy a put. You have the right to sell at the strike price, not the obligation, but the right to sell at the 62. What will happen is that if the market did drop and it went past this 62, it's going to eventually, this 20 delta is going to eventually become a 100. So that means you stop losing at the 62. Buying of a put is bearish. You want it to go down. When you buy a put by itself, just to understand the basis of option strategies. If you buy a put by itself, you want it to go down, you're bearish. But if you marry it to this collar, now coming back to the collar, you guys, we have the 100 shares, we have the put that's bearish, and we have the call that's bearish. But overall, initially at least, the overall trade is bullish. A collar strategy is bullish. You want it to go up always. So in this case, you're starting off with 43 long deltas. And if it dropped and went past the 62, you stop losing there. As you guys can see, your max loss stops. It doesn't go all the way to zero as if you were buying shares. You have a max you can lose here at 537. It's because of that put. That put turns into shares, basically, once it hits the 62 and goes past it. It's going to go from whatever delta it was to 100 delta if it's in the money. It's going to do that 100% of the time. If it expires in the money, that put delta is going to be 100 at that time. So it offsets the shares completely. This is how you have protection to the downside, and this is how you have a limit to the upside when you're doing a collar strategy. Understanding the basic components of this. This strategy could be very, very useful in almost any market, if not any market, because the collar can be done tight. You can do a tight collar, you can do a super wide collar, and everything in between. So, for example, if I decided that instead of doing the 72 and the 62, I can decide to sell the call at, let's just say this 77 strike, which is at a 19 delta. That's going to give me about $83, and then I can buy a put for something less than that. So let's just say I decided to buy the put for this 57 strike here. So that's at a 9 delta. So this is, I would consider this a wide collar because the TastyTrade platform is giving us the expected move, this ruler here that you see that I'm highlighting here. That's the expected move. So on the call side, you're way outside of that at this 19 delta. So it has to go up a ton. On the put side, you're way outside of it at 9 delta. So it has to go down a ton. So in this example, you have a potential to make 915 over the next 39 days or lose just over 1,086 there. So the last kind of basic strategy is the buying of the call, right? We talked about selling the call when we're going over the collar and we were going over the covered call. But with the Bionic Bull, you can buy a call. We don't buy it by using monies. We get it for free. But I just say if we were just buying a call outright so you can kind of understand the basics of the call. When you buy a call, it gives you the right to buy at the strike price, not the obligation, but you have the right to purchase at this 72. And when you buy a call, you technically have unlimited upside potential. Nothing goes up forever, but if it goes up a lot, you're going to be very, very happy by having a call on if it goes up a ton, because you do have unlimited upside within that time frame, that expiration, in this case, 39 days. When you sell the put, though, like we were saying before, when you put this as a Bionic Bull, you're going to sell the put and you're going to sell it to make sure you receive a credit for the overall trade. So the Bionic Bull was look something like this. And so if you sell this put, once again, you have the obligation to purchase at the strike price here. And then when you buy a call, you have the right to purchase. One has an obligation to purchase, which is bullish, and one has a right, but not an obligation to purchase, but still bullish. So this is kind of fascinating how this works to me with options, is that these two trades are bullish, but one has a obligation and one has a right. One has a higher probability and one has unlimited potential. And you want to know the differences. And there's a few other differences that I'm probably not mentioning at this point. But this is the kind of uniqueness of the basics of options. And we tie them both together when we're doing a Bionic Bull. We're selling a put, taking some of those monies, not all, to be able to buy a call and buy that call for obviously less than what we receive for the put. And we get an overall credit. As you can see down here, this is an overall credit of $56 to be able to do this trade and have unlimited upside. As you can see, max profit is undefined. You still have risk all the way to zero when you do a Bionic Bull, just like if you were doing a cash secured put or if you were just buying the shares outright, you have risk all the way to zero. Now, also another type of strategy, basic type of strategy, is a call spread. Let's say we were doing a call spread and we were doing it like this. We're selling this 69 and let's say we were buying this 72. This is going to cost us $120 when you buy in a call spread. So when you buy a call spread, you have a right to be, or you have a right to buy when you for the call that you purchase, and then you also have an obligation to sell. But in this case, your right supersedes your obligation. And if you were just doing a call spread, you have the ability to make money in between the strikes here, which is 3 points or 3 times 100 equals $300. That's the most you can make minus the amount you're paying, which is this 120. And so if you minus the 120 from it, the most you can make is the 180, and that TastyTrade is showing right here. This is a call spread. Sometime we will take that basic type of strategy and we would add a put to it to make it a custom or modified Bionic Bull, which is all within the safeguard strategy. So in this case, if it was going to cost us $119 to buy this call spread, we would want to sell a put for more than this 119, 120. So let's just say we decided we are going to sell this put at the 64 strike here. Well, if we sold this put at the 64 strike, it's going to be for more than the 120. So overall here, we are getting a credit of $33. And then we have the potential to make not only the $33 that we're talking about, but we have the potential to make this 300 between the 69 and the 72. And so that's why here it's saying your max profit is 332. You still have risk all the way to zero when you sell that cash secured put here, but and you don't have all the way upside, but you have a higher probability to make money to the upside in the next 39 days that if you were just buying a call at the 72 or something like that, because you're buying this call right here, this call spread almost at the money, as you can see, because it's trading at 68.28. So this is the way you can kind of do a modified Bionic Bull to be able to get a little bit more upside, but be able to put your put further away.